This is the Great Financial Sense Podcast, episode 4. Good morning, Ryan.
Good morning, James. How you doing?
I'm doing great. Another beautiful, real winter morning here in West Michigan.
Yes, we actually got some snow and plenty of it out there. So interesting getting in here today.
I know. Another month's rolled by.
Yeah, that's right. Here we are, January podcast.
Yeah. Well, let's take a look at January. Looking at the kind of the month-end review.
Yep. So month in review, January, we started off strong. January really, when you're looking at the financial markets, and let's just talk about kind of the S&P 500, I think that's going to be the broadest indicator that would give us a feeling for how the stock market did or didn't do. So, coming to the year, a lot of strength, a lot of momentum. I think that investors were really charged up about getting 2020 in the rear view, maybe getting some of the political issues behind us, right. All of that. So anyway, we started the year strong. Month kind of faded off though. Mm-hmm. I think we had what I would call a healthy pullback towards the end of January. S&P 500 finished the month down about 1.1%. Not too bad. That dip I'm referring to is about 4%.
Oh, so healthy.
Yeah, healthy. And, it's just a way for the market to kind of blow off the froth, make sure that the risk-taking that's out there is prudent. When risks elevate to a point that is not prudent, mm-hmm. the natural healing takes place, right. And the market takes care of business.
Well, looking at the month of January, we touched on it, in the last podcast, but there is this thing called the January effect.
Right. Yeah, so the January effect, it's kind of like, you got the Farmer's Almanac. Well, let's talk about the Stock Picker's Almanac. One of the things that you would find, one of those adages out there would be how January goes the rest of the year, the January effect. Maybe there's some credence to it. I know that going far back in history, you would have seen something like the January effect. But, since 2000s, really, I think it's kind of flip-flopped. And actually, about 90% of the time, if January is down, the year is actually positive. Huh. So, more recently, I think that it's becoming less and less relevant. But, you got to talk about it in the January podcast, right?
There, yeah. So there's been a lot of news in January. And, I think at the beginning of this month, we thought we were going to start with one thing. And now, there's something else. And it's really kind of led to some systemic market movements, and specifically yes. GameStop.
Yeah. So I love the systemic use of term there, because the market is a system, the capital market system. And when you have these anomalies in the system, it's not just specific to a meme stock or a stock that's gained attention on the internet. You're gonna see how maybe that one stock reverberates through the whole system. Right. And so one of the things that we saw happen was, a couple different stocks really caught the eye of a group of investors on the internet, and there were certain things that took place. But here's what we can take away from the internet stocks, the GameStop stocks, is that everything is interconnected. And sometimes you can see market volatility and truly point to something that is causing it. And we kind of saw that play out here mm-hmm. in late in January.
Right. Now, a lot of my clients have kind of asked me, maybe the average client doesn't know what short selling is, but in a way, that's kind of what triggered this group of investors.
Right. It triggered the market volatility. Yeah.
So short selling.
So short selling, and how long do you have? Because, there are many, many different facets and depths to short selling. But let's just keep it simple and compact and just say, if I'm an investor, and in this instance, it was hedge funds, mm-hmm. you have a brokerage account, wherever it is, you own a stock, I can simply borrow that stock from you and actually sell it, take the proceeds with the idea that I will give it back to you at some future date. Mm-hmm. Now, my speculation is that the stock is going to be lower, right? Down. Okay, so I borrowed the stock from you, sold it. Yeah, I know I have to get it back to you, but I'm hoping that I can buy it at a lower price and give it back to you.
Right.
That's called selling short, where I've sold, I don't own it, I borrowed it from you. Now, the risk there, what if the stock keeps going up? Mm-hmm. Well, now I'm going to have to give it back to you at a higher price. And you know what? There may come a time where you go, hey, you borrowed that stock from me and the price is way up there. I want it back right now. That's going to be called a margin call. So what ended up happening was the internet caught attention of these very, very high percentage of shares short, started to drive the price of those stocks up, creating these margin calls on the different hedge funds. Now they have to, buy at a higher price to get it back to you. And this generated losses.
Yeah.
Those losses needed to be covered. So that's why you saw the major indexes, the stocks that we know and love, and they make up the S&P 500, those actually had to be sold to fill the hole that these losses created in the hedge fund community. Now, volume was light when this was all going on. So really the participants in the market at that point in time were all looking to sell. That's where you got the 4% pullback in the market. But guess what? It was that natural healing process.
Right.
The risks just got out of whack. And the market has a way of bringing it right back to the norm.
Well, and I know that you and I are both, definitely market history buffs, and
Yep.
we like the sayings that exist. And the GameStop, actually, we'll call it a situation.
Yeah, that's
It reminded me of a saying that there are no friends on Wall Street.
right. And so let's take this a step further and say that we get to protect our clients from some of the harsh realities that exist in the financial markets. When it starts to feel like it's so easy and it's so simple and all I need to do is jump on this internet stock, the market has a way of writing that in a pretty violent way. And so the market system is really set up for big institutions. Let's just lay it all out there. That is what it is. That's how it's set up. The retail investor, it's tough to swim in those waters where you and I get to wake up every day and go to work and make sure that our clients in this environment that can be very scary, choppy, volatile are protected. We have a solid ship for them to be on. And every single day, we get to make sure that that ship is chartering the right course.
I always say, we've built this fence,
Yep.
and we make sure we know what's coming in and out in terms of the risks that are involved.
Right, exactly.
So, it's just,
when you're dealing with your life savings, this is not a gamble. This is an investment strategy. And, Advanced Capital is very good at it. We're one of Barron's top 100
right.
investment advisors. So it's quite an honor.
And at the beginning of the podcast, I talked about, I thought for sure a certain topic would lead the podcast.
Yeah.
Talking about, we've got a new president.
Yeah.
And Georgia runoffs and political unrest. All these things, that's how the year started. It might even be hard to remember that, but it is.
Right.
So looking at the markets and the economy with that, did we learn anything,
Yeah.
necessarily from some of those outcomes?
So you're not going to leave the political stuff in the rear view because some of it is beyond us now. And let's just say that, when you look at that political lens that we had to look through as we went through the election season, we had the special runoff, we had individuals scaling the wall at the Capitol building. There's all this stuff going on, and there's a couple things to take away from it. Number one, we now know more than we did prior to these events, and right on down to the Georgia runoff. Okay, we know what we're dealing with. So guess what? The portfolios for clients that we're managing are going to align with the environment that we now can see formulating. One of the things, and it's not troubling necessarily, but it's one of these realities. Did you know that the market hit an all-time high when the Capitol was under siege?
That's crazy.
Okay, so what that means is that rarely do you see societal unrest impacting the financial markets. Should it? Maybe. I don't know. But again, we're history buffs. So sometimes the headline is a great headline, but that's it.
They're selling headlines.
They're selling headlines. So I guess what we can take from this is, look, a lot of that stuff's in the rearview mirror. Now we can align investment portfolios going forward. So we're in a position of power.
Well, and that's good.
Yep.
And always looking for the best interest of the clients with whatever those, new rules are.
Right.
One topic that's probably been a topic on every podcast is the stimulus.
Still,
it's in the news.
Yeah. And still, it's a vague, concept out there. But here's the thing: the market has baked it into the cake, so to speak. The market has baked it into the cake, and so I sure hope that the traction continues. I hope that it's well thought out. I hope that that we can move that ball down the road or down the field a bit. And, again, we'll see what comes of the stimulus, but recognize that the market is anticipating it. But hey, the market is also anticipating. So anytime the government spends money, it's called fiscal stimulation. And you're stimulating the economy from a fiscal perspective. There's also something called fiscal contraction that would come with higher taxes and things like that. So, there's movement there.
Right.
And we are paying very close attention to it. Right now, though, it's just kind of, we're waiting for details.
Right. Well, and we might even have some of those details as we look ahead to February.
Right.
January's come and gone.
Yep.
We got blizzard here in West Michigan.
Yeah. Winter is in full swing. February, looking forward, short month. So that's interesting in and of itself. Sometimes you see some different things take place when you get those short months. But I want to take this time to use a Warren Buffett saying, and that is, Warren Buffett said, "When the tide goes out, you see who's swimming naked." And that is really, I think, reflective of what we saw late in the month of January with all the market volatility. It really kind of set up for a healthier move into February. So from that perspective, I'm very constructive. Not to mention, we're hearing fourth quarter 2020 earnings right now, and they're shaping up quite well.
Pretty well.
Doesn't mean we won't have volatility, but I can tell you that move lower and the volatility at the end of January makes me feel better about entering the month of February. And, I think that the conditions are there for a prosperous 2021. So I'm very constructive on that as well.
Well, Ryan, great day today.
Yeah.
Great topics. We look forward to February.
Yep.
And we want to thank everyone for joining us.
Thank you.
And we'll see you next time.
All right.
See you, Ryan.